What's the proper way to benchmark your investment performance, and how should you choose a benchmark to compare your portfolio against? I'll cover all that and give the update on my $0 to $100,000 dividend portfolio in this video, and it's starting now. How's it going, everybody? Welcome back to the channel. If it's your first time here, my name is Jay, and on this channel I give you the tools, the tips, and the tactics that you need to get the most out of your money. And today, we're talking about how to compare your investment portfolio to a benchmark, and I'm giving you all the updates on my $0 to $100,000 portfolio I'm building right here on this channel. Now, when most people talk about their investment performance, they compare themselves to the market. Can you beat the market? Am I beating the market? And most often than not, when they refer to the market, they're referring to the S&P 500. So when you hear people say, oh, this fund outperformed the market by 5%, that generally means that over the last year, the fund they're talking about or the portfolio they're talking about returned 5% more than the S&P 500 did in that same time frame. Now, that's a really easy and quick way to judge how your portfolio is performing, but for most people, it's not really realistic. As I've talked about a lot on this channel, you want your portfolio to be diversified. You want a strategy that will work in all kinds of market conditions, and you want to spread your risk out across different asset classes. The most common example I give is the portfolio I try to stick to, the Core 4 portfolio, where I hold VTI, Vanguard's Total Stock Market Index Fund, which concentrates on United States stocks, VXUS, which is Vanguard's Total World Stock Market Fund, and then BND for a Total Bond Market Index, and VNQ for a Real Estate REIT Index Fund. So those four funds make up the core of my portfolio, and most of you out there probably have something similar. You're not only invested in US stocks, you have some world exposure, you have some bond exposure, maybe you have some cash, some real estate. So comparing your performance against just the S&P 500 doesn't really make sense. How I like to look at benchmarking your performance and comparing your investment returns against something else is comparing them to an alternative investment. Now, in my 401k, I pick out my own investments. I pick out an S&P 500 stock index fund, a world fund, a bond fund, and a real estate index fund. I stick to that same strategy. So when I'm comparing my 401k performance, I like to look at, okay, I chose these four funds. How am I performing against what I would be invested in alternatively? So if I wasn't going to pick out my own four funds, choose my own investments, I would just pick the target date retirement fund that matched when I wanted to retire and let it slide. So for my 401k investment, or if you do something the same in your 401k, it probably makes more sense to judge your 401k performance against what that alternative fund you may have chosen if you didn't invest the way you did is. Now, I'm not sure if that's the correct or best or most popular way to benchmark your investment performance against something else, but in my mind, it's the most accurate way to do that, because by investing the way I do, my goal is to outperform that alternative investment if I took the easy way out, let's say. So that brings me right into my $0 to $100,000 dividend portfolio that I've been building here on the channel. And if you've missed the earlier videos where I talk about what's been going on in this portfolio so far, I'll put a link to the playlist of the videos in the description below. Please check them out. While you're down there, give this video a like, give it a thumbs up, help spread the word. So my goal, building this portfolio from $0 up to $100,000 using just dividend stocks, is to start creating a little source of passive income, an alternative income stream for myself. So by going about and choosing my own individual dividend stocks, I'm hoping that I can outperform a simpler, more hands-off approach. And in this case, that would be investing in VYM, Vanguard's High Dividend Yield Index Fund. If I can't outperform that, I'm probably better off just saving myself the time of researching, picking these stocks, and putting my money into that dividend index fund. I can save myself time and get better returns. That's probably what I should be doing. And like with my 401k example earlier, if picking out my 4 funds, if I can't outperform that target date retirement fund, well, I'm gonna save myself the time and energy and just stick to that if that performs better. So I hope that gives you a little insight into my thoughts on benchmarking your investment performance and how to compare your returns, against the alternative. So leave me a comment. Let me know in the description below what you guys choose to benchmark your returns against. Is it the S&P 500? Is it a target date fund? Is it something else? Let me know what you think of my strategy. Let me know what you guys do. I'd love to hear it. Let's get a discussion going. Okay, so now let's get to the update of my $0 to $100,000 dividend portfolio. So if you haven't seen any of my prior updates, I'll catch you up quickly. This portfolio, I started on Robinhood with $0 a few months ago with the goal of growing it to $100,000. I invest $100 a week of my own money. I have a Patreon page linked below. Anyone that signs up for that, all those contributions will go directly into this, and those people will get a say on future investments I make in the portfolio. So now I'll get into the new stocks I've purchased since my last update, and we'll compare my returns so far against that Vanguard Dividend Index Fund VYM. So let's get into it. So here we are in the Robinhood app. You can see the portfolio is up to almost $4,600 from zero. My return so far is 27.35%. I've made almost $1,000 in real money, 27% in just a couple months I've been investing in this. Awesome. Now, I will say to everyone, I've been strongly considering moving this portfolio out of Robinhood and moving it over to Webull. If you haven't been paying attention, Robinhood has had more security issues. A while back, there was a bunch of people got hacked. So that is on my mind. I'm considering it. I do really like Webull. Again, you can sign up, link below. If you're watching this soon after posting, they're currently giving away 4 free stocks to anyone that signs up and deposits $100. So jump on that in the link below. But for now, we're sticking to Robinhood. But to let you guys know, I am paying attention to that kind of stuff. Considering moving this from Robinhood to Webull. So I'll keep you updated in future updates about that. But we're sitting at almost $4,600, $4,584.42, up $984.42, which is 27.35%. Now you can see, boom, July 1st, I think. June 30th, you can see I've put in $3,600 of my own money into this portfolio since July 1st when I started this. You can see we started down. I don't know what this big up and down swing there is on October 23rd, 24th there. I don't know what that's all about, but then boom, we rocket up in these past week or so to now where we are above $4,500. So right now we're getting awesome performance. Let's scroll down, look stock by stock and how each investment I've made is performing. So we'll start off right at the top. Again, disclaimer, Plug Power, the top stock here, was the free stock I got for signing up for Robinhood. I liked the prospects of it, so I invested $500 more in it. And this stock is killing it for me. I am up 159% on Plug Power since I bought it. So it's not a dividend stock, even though it's in here, and it's crushing it for me. So that's kind of weighting my performance so far, but what can we do? Next down the line is Coca-Cola. I'm up to just over 14 shares of Coke. I've been continually adding to that. That's a core holding of this dividend portfolio, and we're up 5.6% so far on our Coke investments. Now, it's a little confusing. I'm recording this on a weekend. The markets are closed. Some of these stocks are in red because they closed down on Friday, which is kind of screwing with showing what my overall performance is. Like Coke, we're up 5.6%, but it's showing in red. Next stock on our list though is Cisco. We have 9.74 shares and we're basically breaking even. We're down about 1% on Cisco so far. I'm not sweating over that. Next up, O, which is Realty Income. We are up to 4.13 shares on that. Again, just about breaking even, treading water on that. We're down 0.85%. Then the next stock on the list is AT&T. Now AT&T, we have just over 10.5 shares of AT&T, and we're down 3.6% on our AT&T investment. Now, I said when I originally bought AT&T, I knew they had some struggles. With AT&T, they have a very high dividend yield right now. So if AT&T can just tread water and keep paying us that 6 to 7% dividend they got for a while, I'm not so concerned about the actual stock performance of AT&T. As long as that dividend is safe, they keep paying me my 7% per quarter, and hopefully eventually AT&T's share price will also rebound. So we started off good with Plug Power and Coca-Cola, 2 winners there. The next 3, Cisco, Realty Income, AT&T, 3 losers so far over the couple months I've had this portfolio. Not gonna do anything drastic, not gonna sell them. We're in this for the long haul. Nothing has changed about the core businesses to worry me. That is the only time I would sell, is if something drastically changes with the core of the business. Now, moving on down the list, we have Colgate. We have 4.5 shares of Colgate, and we're up 9.22%. So awesome performance out of Colgate, up 9% in just a few months there. That's doing great for us. And then in one of my earlier updates, I mentioned how I took a big risk on a company that had some terribly bad news going on for it. That was HSBC. I think they and a bunch of the other big banks got busted for some money laundering and shady business that the big banks get into all the time. So I kind of knew it wasn't going to kill them because, if there's anything we've seen over the past 15 or so years, it's no one punishes the big banks. So we have 10.55 shares of HSBC. Currently paying, let me click into here. HSBC is, they still have a 10% dividend yield, and we're up 33% on HSBC from when we bought it. So a couple months into that investment, it's looking like a genius move. Pat myself on the back. Let's hope HSBC continues to recover. Let's hope that dividend stays safe. We get a few more months of that extremely high yield, and hopefully as they recover, that'll normalize and stay safe. And we'll do great because we seem to buy at the very bottom. Now we're getting into our 2 new additions. So let's introduce you to those. First up is NextEra Energy. And we have 6.64 shares of NextEra Energy. We are, again, essentially even. We're up 0.78%. I've only had this stock for maybe just over a month, so not a lot of time yet. Now, NextEra Energy is an electric energy company that is big into green energy. So they've been paying a good dividend. They have a lot of growth prospects in solar and wind, green energy, etc. So that's why I got into NextEra Energy. I actually deviated from my stock picking criteria for this a little on NextEra Energy because they had a pretty high PE ratio. But I'm that excited about the future of this company, the prospects of this company, that I just wanted to get in. I got in. We're treading water so far, but we'll see where that goes. I'm excited for the future there. And the last new stock we have is Brookfield Renewable Energy. We have 6.12 shares of Brookfield. And again, I bought this around the same time as NextEra Energy, so just over a month ago, and we're already up 10.73%, so almost 11% on this stock in a month. And again, Brookfield Renewable, another energy company, big into renewables, green energy, again, a nice dividend payer. So I'm excited about the future of these two stocks. So that's the stock by stock breakdown. Again, since I started this portfolio, we're up almost $1,000 at this point, 27.35%. So now let's compare that to our benchmark, which is the Vanguard High Dividend Yield ETF, VYM. So now if you look at this chart of the performance of VYM over the same time period that I have had this $0 to $100,000 dividend portfolio going, you can see VYM has returned just over 11%, almost 12% over that time frame. And my portfolio is up over 27%. So I'm outperforming my benchmark by over 15% so far. Now, I cheated a little bit because I'm getting amazing returns out of Plug Power, which isn't a dividend stock, it's really a growth stock. And that's kind of weighting my returns in my portfolio a little bit. But again, I said when I started this, that stock was already in there, we're gonna count it. So we're outperforming the benchmark by 15%. Let's hope we can keep that up. I'm gonna keep contributing my $100 per week and dollar cost averaging into these positions. And if I add any new positions, I will be sure to keep you guys updated in my next update. So check out the other videos in this playlist and the other videos I have right over here next to me. Leave a like on this video if you enjoyed it. Leave me a comment below telling me how you benchmark your returns, and I will see you in the next video.